Global markets began the year at all-time high levels, and market participants already asking themselves, are we due for a crash? It's important to remember that we are potentially going through quite a Goldilocks moment where we've got global synchronized growth across the major regions in the world. We've got Japan expected to grow at 1.5% this year. We've got Europe coming back, and we've got the US already having entered a hiking cycle, meaning that inflation is likely to come back in that economy. We are certainly not concerned about inflation in the US and don't expect that interest rates are likely to rise aggressively. So we can potentially expect that markets continue to rise. Are they really expensive? We don't think they are ridiculous, but there are certain sectors in that economy that have shown excessively high multiples, such as your FANG stocks. But it's also important to remember that they also bring through high earnings, and so those multiples can unwind quite quickly. There are still some sectors that offer reasonable growth for the foreseeable future, such as your financial stocks, where something like the recent tax reform in the US is likely to support sectors like that. Given this, we certainly think that a diversified strategy holding both South African exposure as well as global exposure is the way to best manage portfolios, especially if one thinks that over the long term, the rand is likely to weaken relative to major currencies. Certainly in the short to near term, we would expect that the rand is supported and strengthens as we see positive outcomes politically, and can expect that the South African economy starts to show decent growth of above 1%, which is currently not expected.